Starbucks investors may be a little bit jittery after the earnings release that we got last night. It's not because of the coffee. So we're going to talk a little bit about that. We're going to talk a little bit about Meta earnings. We're going to talk about the GDP data that we got. And hopefully we're going to be joined very shortly by Brian Stutland today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. On Monday, we did talk about Starbucks. I actually found this reusable plastic Starbucks cup in the cupboard, so I decided I would use that for my coffee today in honor or dishonor of the earnings result. So I'll take a sip of it. And hopefully we're going to be joined very soon by Brian Stutland. I understand he was going to join us for as long as he could, which was going to be up until, I think, about 5 p.m. or so Eastern Time. For those that don't know, Brian got his undergraduate and graduate degree at the University of Michigan, where he was also a baseball player, and he now coaches baseball, among the many other things that he does, over at Equity Armor Investments. So he has only a limited amount of time before he can get over to that practice. So we got the earnings result. Arguably, this was the first earnings result I think that we can really sort of assign exclusively to Brian Niccol, the new CEO, who I previously mentioned had come over from Chipotle, and before that he had managed the turnaround at Taco Bell. Those results, so the stock was down a decent bit today. Now, of course, the market overall was a little bit choppy, but I'm going to bring this up here, and we can just take a quick peek at how Starbucks is doing. And then we're going to talk a little bit about their results and what I'm thinking at this point. And we can also review one of the trade structures I think that I had highlighted, and also how some other structures might have done in similar circumstances given the move that we had. So stock closed, looks like it closed just below $80. So that's a decline of about 5%. So that is within the implied move. It should be said that this thing was at one point last night, I think it traded down with a 76 handle on it. So it, overnight and at various points today, I think the stock actually had been trading at a much lower level. You can see that it opened up. Where did it open here? Yeah, it was actually, okay, so yeah, it opened up around 76, 75-ish or so this morning. Obviously, it bounced back a little bit. Those of you who are watching on Monday will recall that one of the things I had mentioned was the Placer AI data. So that's alternative data, just for those who either don't remember or who haven't watched before. Placer AI data is an alternative source of data where they track mobile devices, and they have tens of millions of mobile devices that they track, and they map the movements of those devices to known locations, including retail outlets. And that data was not as good as the Bloomberg second source data was when we were looking at this ahead of earnings. So the Bloomberg second source data suggested that things were looking okay for Starbucks. I think I have this up. I'm going to have to blow this up just a little bit so we can get a better look at it. I want to make sure this is visible to you guys. But this is actually what I was highlighting on Monday, which is that the second measure data from Bloomberg actually suggested that the year-on-year growth for Starbucks as of month ending March 31st. And I'm very glad to see that Brian looks like he was able to join us, so that's going to be great, and hopefully he can hear me as well. So the Bloomberg second measure data, that was suggesting that Starbucks was doing better than the industry overall. But the Placer AI data, and that's the one that tracks everybody's mobile phones so they can sort of see whether people are walking into a Starbucks or not, that one actually indicated that for that quarter, which they just reported, the data was actually a little bit worse than the industry average. So let's just talk a little bit about it. So first of all, they missed the earnings by about 4 cents. And a couple of the observations we made. So comparable sales in China were flat net of the average ticket charge, but the transactions were actually higher. So transactions higher, ticket charge lower. In Europe, they also actually had a small boost on the comparable sales, and that's net of both. So basically, they did see some growth. But in North America, they actually saw a decline, and a fairly notable one at that. And that's a problem for Starbucks because North America represents about 75% of the company's revenues. And I recognize that a lot of people are looking for the growth story and all that. But, that's got me thinking this is going to take a little bit more time to turn around. The other thing, which I thought was notable, and let me see if I can come up with the exact quote. I had it around here somewhere, but I will give you the gist of it if I don't have it immediately handy. I do not have it immediately handy. One of the things that Brian and Nicole said was that their analysis suggested that they were getting better improvements on throughput by spending money on labor than they were on technology. So the company, you may know, under previous CEOs, had really been trying to make a push on the technology side. Some of that technology had to do with automating some of the coffee making. In fact, the Starbucks that's closest to me has this. Some of it was related to digital transactions. He was talking very specifically about increasing their spend on labor and decreasing, or in their words exactly, minimizing capital expenditures on equipment. So I wanted to leave you with that. That sounds like a slowish turnaround to me. That's the Starbucks story. And so while I load up a trade, I'm going to say, hey, Brian, how are you? I'm glad you were able to join us. We know we don't have you for that long because I was explaining to the viewers that you are a baseball player, or you were one, and now you're a baseball coach.
That's right.
And that you have other duties other than managing assets during the day. And by the way, for anybody who's watching who doesn't know, Equity Armor Investments, you can always go and check them out. And Brian has a couple other services. How are you? And what are your thoughts out of this GDP number we just got?
Well, I think along the line, just to touch on the Starbucks numbers too, because I think they kind of correlate with what the GDP numbers came out, which was down and not great. Obviously, the market didn't like the number initially. We saw trading lower. Then we got a PCE core inflation number that came out at 10 a.m. Eastern time, and all of a sudden the market kind of turned around and said, well, maybe it was saying we don't have this stagflation that maybe we thought we could be in trouble for. So, just turning back on Starbucks, obviously, a $6 caramel macchiato, people can only afford that for so long, I think. And I think there's, some catching up that's being done in that area. And it's showing that the GDP number is not just maybe tariff implications, things slowing down due to that, but more so the consumer slowing down a little bit as well, which will make it, everybody's saying tariff, inflation's coming, inflation may not happen because the consumer may not be able to afford it.
Yeah. I think that's a great point. I mean, a $6 caramel macchiato, as you were just saying, my wife, she always wants some special thing. It drives me crazy if I have to go over there and pick something up for her because she has a very specific order. And the specific order is not the same, so it's not like I can save it in my phone and redo it. She'll say, well, tell me what they have. What special lattes do they have? And then you have to use oat milk and no whipped cream and all this other kind of stuff. Anyway, I made the observation that, and she's not even getting the largest drink. It was like $7.
Yeah.
The last time I went there for a cup of coffee this size. This is a grande, folks, in case you're wondering. So I made a habit of getting the recycling cups because I like to keep them in my car if and when. I don't actually go to Starbucks in store that often, but I think you're right. I think we got some other data today. You may have seen it, that auto loan rejections. So auto loan application rejections are also reaching fresh highs that haven't been seen basically since GFC, I think. And one of our crack production staff can probably pull that up on the lower third. But I think that speaks to it. I also saw that some mortgage refinancing applications are also getting rejected at a historic rate. So, you you manage assets on behalf. The interesting thing about your position now, once upon a time you were a vol trader, you were a floor trader like me, and we kind of lived in our own little bubble down there on the floor because we didn't talk to people except each other, and we were usually yelling. So we really didn't interact with sort of, if we'll call it this, the man on the street that often. But you do now. I mean, what's your sense of it? I realize you appeal to a sort of more upmarket demographic by virtue of the fact that you're an asset manager. But what are you sort of seeing and hearing?
Yeah, I'm hearing more so not so much investors that being spooked out. I think the volatility that happened almost happened too fast to freak anybody really out of this market. It went down so quickly. Then the administration sort of retracted how much the tariffs are going to be. They delayed when they're going to happen, and the market came back so quickly that I don't think even people really had time to digest what actually had happened to their portfolios. Although I'm sure there are some, individuals that might have concentrations in some of the tech sectors that obviously have been hit this year, feeling some pain. I see more concern coming from people that are in the sales of supply industry that import, and they're definitely in the camp. There's some areas where they're like, look, this extra tariff, no problem. We get it so cheap from Cambodia right now that it's not going to matter that there's an extra whatever 10% on there. But in other areas, there are importers that are definitely like, look, our business, we don't know where we're going with this right now. And there is a lot of uncertainty. And I think that's why you're seeing elevated volatility in the marketplace. It's why the market today was down, almost 2% and then closed up on the day, right? And so that uncertainty that those suppliers or manufacturers are feeling, that uncertainty is echoing in the stock market. And there is definitely some confusion there. And it's going to be interesting to see how this all plays out.
So I think when I was talking to you before we went live today on an earlier call, you don't happen to own Starbucks for any of your funds or any of your separately managed accounts, I don't believe. Is that right?
That's correct. We don't. We've kind of shied away from it. We were in it maybe a couple of years ago. And I think with these inflationary prices, like I mentioned, we felt that this was coming down the pipeline. The earnings report was exactly how we felt this stock would behave. And we kind of felt like there's maybe some other areas of consumer discretionary that we could sort of tackle. I mean, one of them being, I think Amazon almost is all-encompassing. I know obviously their cloud computing, their AI play, but them as an all-encompassing consumer discretionary play has always been top on our list in terms of some of those names in that space. And then obviously you have Home Depot, Costco, some of those names. I'm a little bit where there's just, demand at ends with where some of the pricing pressures has been able to be passed on to consumers. But we'll see how it all plays out after this quarter.
Yeah, it's interesting that you mentioned Amazon, Costco, and Walmart. And the reason I find it kind of interesting is because, Costco's valuation had gotten to nosebleed levels, in my opinion.
It was.
It has, obviously, like a lot of other things, it has pulled back somewhat. Amazon, we are going to get earnings tomorrow. But what interests me here a little bit is that, when we used to historically compare an outfit like Amazon, and we'll ignore AWS for the moment, I think there was not much doubt many years ago. I can still remember people complaining about the valuation in Amazon on fast money back in, the 2020 teens. But the gist of it was, and I'm going to pull this up over here. Actually, I'm going to pull up the financials for this thing. And that is that Amazon, I think, at this point is actually cheaper than either of the two aforementioned stocks versus forward earnings. Yeah. So it's trading 22 times full year 2026 numbers. 22 times, which, by the way, is 2 turns cheaper than the S&P itself was at its highs earlier this year. Walmart, meanwhile, is trading. What we got here? This one is trading. So the street's looking for about, $2.95 a share ish. for next year. So that's going to get us to round numbers 30, 32 times full year. And Costco, I can pull this up here so we can just take a look. And by the way, so you can see Walmart. You can just take a look at, Walmart. First I was talking about Amazon. So we can actually take a look at, their earnings per share, and you can sort of see that in this chart right here. Hopefully that shows. It does. There is some. This is net of employee stock grants and options, and the net effect of buybacks. We'll just throw Walmart in here, and we can see what their growth rate looks like. And you can see it's clearly a much flatter curve. Somewhat unsurprisingly, Amazon's growth exceeds that of Walmart. I don't think that's going to surprise anybody, but it might surprise them that it trades at a cheaper multiple. Costco, meanwhile, in its own way, it deserves a premium, I would say, simply because they have the subscription revenue. So you own Walmart and Costco and Amazon?
That's correct. Yeah. I think, you make the point on the valuation on Amazon. Amazon's probably maybe the most attractive there. I think that's a stock where you take a look at it and they've got so much more beyond consumer discretionary. Probably has been maybe hit a little bit too hard, and this is why the multiple looking lower than some of its other consumer discretionary peers is because it's kind of been taken down with the rest of the AI world, and is the spend been too much? The Microsofts, the Metas of the world, and whatnot. And so the question becomes, has it been discounted enough for that? Plus their consumer discretionary business. Look, I'm a little worried. I might even want to think about buying, if I was going to trade options, maybe a put spread on the stock on the downside just to get a little protection. But I think the valuation looks kind of interesting. And you saw how much the stock shook people out on the Trump debate about they were going to list the tariffs. Then they said, no, we're going to take them off our website. We won't do it. I'm sorry, Mr. Trump, for ever thinking and considering that. And then the stock went right back up. And actually, I think that little flush out might have been the flush out needed prior to earnings, where it's going to send the stock higher, because I think it kind of squeezed the shorts right out.
Yeah, that was certainly an interesting exchange. It's hard to imagine the prior administration sort of having these one-on-one conversations with, the leadership of, the country's biggest companies. And that cuts both ways, right? So that can mean that you have a situation where the president calls Jeff Bezos and says, yeah, you're thinking about putting that on your website? Don't do that. Don't do that. Or, a phone call from, the Mari Barras of the world and others who would, say, hey, listen, this is going to have a real impact on the auto business, and we can't adjust our supply chains quickly enough. We've got to make some kind of an adjustment. Yep. And that kind of give and take, I think it's healthy. It's hard for me to imagine how that gets completely managed at scale. There's a lot of different businesses that are affected in a lot of different ways, and surely the president can't have calls with each and every one of them, and you can't really get quick policy by executive order that captures the nuance of all of those, could you?
No, right, yeah. I mean, certainly you can't have your hands in everything at every time. That starts sounding like a socialistic government agenda kind of thing, and I think the Republicans are all about capitalism. So, I don't know that necessarily happens, but certainly the administration felt a little slighted with what Amazon was about to try and do. But again, I think that actual flush out might be a good thing for the stock to sort of carpet shake out the shorts and run them over, and makes it easier. If they beat on earnings here, the stock could go significantly higher. But I will say, based on the Starbucks, Walmart earnings weren't great, Costco earnings weren't great either. So that has me a little bit concerned about the downside. That's why if I was long the stock, maybe an individual trader, I might look to buy a put spread, something cheaper, sort of offset, not outlay a ton of capital, protect a little bit to the downside, but continue to hold that long stock and play to the upside.
Yeah, so actually, you know what? We should probably just take a quick peek since they are about to report tomorrow. Why don't we just quickly see what we've got for an implied move in this thing? And maybe we'll even take a look at a theoretical put spread, as you suggest. So the expected move is about 5.7%. Not that big, really, given the environment we're in. I'd actually say that makes options prices fairly reasonable. As we can see, this is 12 quarters, so this is the prior 11 plus the earnings that we're getting tomorrow. You can see this is kind of in line, which is rather surprising to me when you consider the environment we're in. I'm sure it probably in some ways might surprise you also. That how far out in time would you go on that put spread, do you think?
I would probably stay somewhat short dated actually, because I think this is going to be a one-time event, and it does feel like the market could move higher. I think the reversal we just in the broad market, and obviously Amazon follows that a little bit. We did see a nice little shakeout today. I really thought the market was going to head lower on that GDP number, and it really reversed pretty hard. We're trading even higher after hours right now as Meta earnings have come out and seem to be pretty good. So I would stay pretty short dated with this put spread. Maybe just look at like just the May regular expiration.
That's the one I loaded up here.
Yeah, there you go. Great minds think alike, right?
Yeah.
Yeah, something around maybe around like the 180 put.
Other than you, who's the other one that we're talking about? Because it can't possibly be me. Yeah, so that's going to cost, it's interesting. I'm looking at the 180, 160. So I just took a look, and in the last 11 reported quarters, the two bad quarters that we saw, so just going back to unusual whales here. So back when they reported their Q4 22 numbers, stock fell about 8.5% the day following, and about 8.8% the day following a year ago, actually. So we're looking back, at the second quarter from last year. That was nearly a 9% decline. So if let's assume that you're buying a put spread as disaster protection, not to mitigate an everyday move. I mean, the stock moved 1.6% today, so you're not trying to hedge that out, I assume. So would you typically try to put something like this on, to sort of capture the stuff that would be worse than 5% to the downside, for example?
Yeah, I guess, if you looked at maybe disaster 9 or 10% move to the downside, if they really miss bad. So you're probably what is that? It takes you right about the 165 strike where you probably want to sell that put. Probably.
Yeah, so I'm taking a look at it. 175, that's basically what your break even on the 180, 160 would be, which costs a little less than $4. We'll call it $4. So $4 for a $20 wide spread, payoff of 4 to 1. If the stock falls to 175, that's your break even, which against 184 stock is a decline of just under 5%. So, and then, in terms of how much you're spending, because we always want to think about that as well. So you're spending about 2%, 2.2% of the current stock price to put that on. And this thing isn't going to go, if the stock goes sideways, this will decline in value to be sure, but it's not going to go to zero.
Right.
So, because you still got a couple weeks to go. So, yeah, Amazon's broadly held. Probably a lot of you watching hold it. So, something to think about. FinWest says, good morning. Nice recovery in the market. The final minutes earnings and the big names looking positive. Yeah, so I'm not that surprised, I have to say, by Meta. We talked about this last week. People are all in a twit about CapEx. If it's not looking to management, meaning Mark Zuckerberg, like it's going to pay off, he can always just pull that back. But we got a question here, which I think is right up your alley. What is your practice on hedges with SPX put spreads when implied volatility is high? So he says, say the 46-4200 when the SPX was 4800 and going lower, and now with the VIX going lower. Okay, so we can probably get a sense of what time frame you were thinking of just by going back and seeing where the VIX was when the S&P was approximately that level. So the S&P was about, and you lived it, so the S&P was, did it get to 4,800? It didn't really.
Just above it. I think, 49.50 or so?
49 and change, yeah. So we'll call it 4,900. That was April 8th, 7th, 8th, in that neighborhood, right?
Correct.
and the VIX was, yeah, it really got up there. Closed at 52. Yeah, I guess I remembered that it was really high. I don't know if I remembered it was closed above 50. So what are your thoughts there?
Yeah, I mean, actually, I think a put spread when volatility is high, especially that we just outlined one for Amazon, right? Which those implied volatilities are high relative because there's an earnings event. So you got to think of it same thing. This is kind of like an earnings event for the stock market, right? When you see the VIX get to 50, market participants are saying there's some real trouble, or we're going to get a nasty whip back to the upside. So under those conditions, put spreads, in my mind, actually make a lot of sense, especially when you look at maybe looking to sell around like the 25 delta-ish, 20 delta put. When you do see volatility elevated that high, that.
So what are you getting on the long side, like a 40 delta, 45 delta, maybe even 50, and then selling the 20?
Correct. Yes.
Yeah.
Yeah. So you got a put that's maybe at the money or a little bit out of the money that you're long, and then selling maybe like a 20 delta put. When volatility is low, I don't like selling that put as necessarily because you can kind of get run over on that. I think when volatility is very high, the premium decline that occurs in those options is pretty drastic. So that's where I probably would be more of a seller in that situation. And even though 50 delta put options are expensive when VIX premium is high, VIX is high and those premiums are high for a reason. So my expectation would be is if I'm wrong about buying this put spread, the move higher in the market is so great that I don't really care about the 2% or 1% that I'm throwing out the door, I guess, so to speak, with the hedge, and willing to lose that in order to make 10% back to the upside, which is what did occur in the situation. So I mean, obviously hindsight's 2020 looking back on it, but a 50 delta, 45 delta put long with a short 20 delta put, to me, makes a lot of sense when vol gets high and you're really, really nervous and you don't want to blow out of your position in the market necessarily and then miss the upside.
Yeah, I would add something, and I know this factors into your calculus on this. So a couple quick things. This is just a general thing, which I know a lot of viewers know already, and is very much baked into Brian's reality as a former VIX trader, VIX options trader, and somebody who trades SPX actively for the funds he manages now. But one of the things that happens when the VIX gets very high, that usually is going to have corresponded with a material pullback in the market. So, you're probably looking at a market that's off more than 10% from its peak to where you sit if you're looking at VIX levels like you already saw.
Yes.
And what that indicates is, number one, that some of the damage has already been done, right? So if you're trying to go out and reach for disaster protection at that point after the market's down 10, or in this case it was down, I think, more than 15% when it reached those levels. It was more like 16% decline or more. And for the Qs, it was we were down more than 20% at that point in April. So to go and try to reach for disaster protection in that case doesn't make a whole lot of sense. The other thing is that when implied volatility rises, that 20 delta put is further out of the money, right? So in percentage terms, the width of that spread, if you're selling the 20 delta put, is going to be much broader than it is. If you had sold a 20 delta put when the S&P was trading 6,100, that spread in percentage terms wouldn't have been all that great because vol was low. But as vol goes higher, the spread widens. And so that serves. So that's two things already that favor spreads, as you suggest, in situations when the VIX is high. Number one, you got a lot of premium that could get sucked out of those options, particularly if you suddenly get a reversal, kind of like the one we got. Two, a lot of the damage is already done in the market. And third, and this is sort of just a general technical thing, very high VIX readings tend to correspond with high fear, generally. They call it the fear index for a reason. And if you have a lot of fear in the market, that can signal that you're oversold in the near term. And so oftentimes you get fairly vicious bounces. Even in a bear market, you can get vicious bounces, yeah?
Yeah, I mean, I've seen guys where they're like, VIX gets above 30 into the 40s. investment advisors are like, I'm putting new cash to work. Like I don't
Hmm.
care what happens. I've got new cash. The VIX is this high. I'm either gonna, I know advisors that trade structured notes, which is a form of selling put options, so to speak, in the market. I know advisors that are just like, I'm putting new cash to work, and I'm not going to look back. And so, as that new money is coming into the market when volatility is that high, you don't. That's why the chance of being run over is greater. And to the point too on the Amazon put spread, like you're saying, if earnings are good, the stock goes up. Most likely, the long put it's not going to go to zero right away. There's some time to go. So if you're looking at a put spread that's let's say you're trading maybe a somewhere between 15 and 30 days out on this put spread, hopefully the long strike put holds some value as volatility stays elevated until the market works itself out. And if you want to dump sort of that long put, there'll be some opportunity to at least recoup some of the losses on the put spread protection that you've put on.
Yeah, that short put that you're selling in this case, if the stock does nothing, that is going to become worthless.
Yeah.
So you'll get a chance to cover that thing and close out that put spread. And that's another way to think about it. Like how much is a put spread worth? And in a high vol environment or a low vol environment, obviously it's a long vega exposure. If the at the money strike is the one that you're long. But it's certainly lower than it otherwise would have been. And a lot of times those wings, I mean, they really get beaten up. They go to zero when vol gets sucked out or as expiration approaches. Whereas the at-the-money options are going to preserve some value as a percentage of the current stock price right up until the moment they expire. One way to think about that, folks, is that if Amazon's $180 and you are long the 180 puts, okay, and the stock just stays there, those expire on May 16th. How much will the 180 straddle be worth on May 15th? With 1 day to go, how much is that straddle going to be worth? And let's get a way for in the back of your mind to recall or just contemplate how much value there is. If it's a 30 vol stock, let's call it 32 vol, keep it with 35, whatever. Let's say it's 35 volatility. So how much is what's a 1 day straddle going to be in a 35 vol stock at the money? Brian?
It should be about 2%, right? A little bit more than 2% or so.
Yeah, I mean the value of the straddle is going to be the mean absolute deviation for 1 day, which is the standard deviation, which is going to be the volatility annualized volatility divided by 16 times the square root of 2 over pi, right? So 35 vol is going to be about 2%, as you said.
Yeah.
Right? It's going to be pretty much right on that number, which means that put is going to be worth 1% the day before it expires, if it's at the money still, right? And what are we spending on this put spread with more than 2 weeks to go? Less than 3%, right? So like we said, you're not risking 100% if the stock just goes sideways from here. So Eileen says, I feel bad for Starbucks. It's not that hard to make good tasting drinks. Well, I don't know. I've had some pretty bad coffee, I have to say. At some places I've gone into restaurants and thought, how long has this thing been sitting here cooking away at 150 degrees or whatever it is? McCafe does it well too, and they're less expensive. Dutch Brothers has an amazing drink selection and is opening more locations. So I can't speak to Dutch Brothers because it's not, I'm more interested in the stock situation. McCafe, of course, is McDonald's. What do you think of McDonald's? Do you own them?
Yeah, McDonald's we do. McDonald's is kind of interesting, but we kind of own it as sort of a value play, as sort of a diversifier. It actually is pretty good. Like most stocks, I mean, Mike, you and I talk about correlations all the time on this show. Correlations will tend to go to 1 when the market goes down. But actually, McDonald's is one of those names that does pretty well in sort of recessionary kind of times. So we do feel it's like a pretty good diversifier on a portfolio, lower the correlation of your portfolio, thus lower the volatility of your day-to-day movement you see, while still getting, kind of S&P kind of returns because you're probably in some other higher risk names. So McDonald's is one of those names that we kind of feel like lowers the beta of the portfolio without really giving up, too much on the upside, assuming the economy, continues to sort of chug along.
So that's an interesting one. And I'm glad, Eileen, that you brought up McCafe, because there's a couple things about McDonald's I'd like people to think about. First of all, they did a little bit of a transformation in their business as well over the last several years. Part of that has been modernizing stores. Part of that has been digitization, online mobile app ordering, things like that. And that's, I think, how people think about it. There is a trade down effect. Can't afford to go down to sort of fast casual restaurants, so you to go to fast food restaurants. The other thing is that I think a lot of people who go to a McDonald's, it's probably partially out of necessity. You're driving down the highway, you got to get a bite to eat, and that's what's there, right? So I think sometimes people who are buying this stuff, they're not likely going to, trade out completely and say, okay, because cooking at home isn't going to save you a whole lot versus McDonald's, even at the ridiculous prices for a value meal these days.
Yeah.
But the more important thing is that part of their business reshuffle involved one important thing, and then there's an aspect of their business that some people may not be familiar with: the refranchising of a lot of corporate stores. So one of the things they had done was, at one point, they were operating more corporate stores, and then they began to say, you know what, we don't want to be in the restaurant operating business. We're a franchise operation. Other small business people will run the stores, and they will license with us. Which brings me to the second part, which is their business model as a licensing operation is based on gross revenues. And this is something that often gets lost, because I hear people talking about it here in San Francisco, need to raise the minimum wage for fast food workers so they get paid something a living wage. Same thing in New York. In New York, they were doing this. And they kept saying these companies can afford it. But the funny thing is, if you raise the minimum wage and the small business owner who owns that franchise restaurant has to hike their prices to compensate for that increased wage expense, McDonald's benefits because they're not paying the wages. They get paid a gross royalty on sales. So if the prices go higher and they do more sales, if a store goes from making $5 million in sales in 1 year to $5.5 million next year, the amount of money that McDonald's corporate makes just went up by 10%, whether the franchise operator sees an increase in 10% of their net income or not.
Right. Well, that's the business of like franchise ownership, right? Is you are more subjected to employee costs than the higher corporate level, right? So so they may be able to get through on increased wages, which will be interesting to see how this all plays out. Like, are wages actually going to be able to go up just because we charge tariffs on other stuff like furniture or electronics? Is that going to make all wages go up because there's demand for other areas? Is manufacturing actually going to come really steamrolling back in the United States, or what's going to happen?
Well, first of all, I would love to see increased manufacturing in the United States. I consider it a security issue for the country. I think there are benefits to being able to manufacture in the country. I saw somebody commenting that in the 1980s, 80% of the clothing that Americans wore was manufactured in the United States. I couldn't believe that. I thought, is that true? Because it's almost unimaginable now. I don't know what the percentage is, but it's probably single digits. I don't know that we want to have all these textile mills back, but I will certainly say that it would be better if we did more of our own manufacturing, if and when and where we can. And there are some companies that are indicating that they're ready and able and willing to do that. And we do have some new auto plants in the country. I mean, I don't know how things are in Illinois, but it's outrageous. But we actually manufacture cars in California now at Tesla, which is just unbelievable. If you can build new cars, if you can build a new car plant and you can build new cars in California, then you've got to be able to do it in the center of the country.
Oh yeah, for sure. And actually, Rivian opened up a plant in Normal, Illinois, which is about an hour and a half from where I'm at, and that's the big center for their manufacturing of the Rivian truck. So, I guess it's happening, right? I mean, it might take a little while. Some might stay here, some might go to other countries, but you're right. For security reasons, to have it come back is probably the right thing.
Yeah, I mean, if you can imagine if Taiwan was the only place that semiconductors were manufactured, full stop. So every semiconductor that we had was in Taiwan. And let's further imagine that China makes good on the implicit threat that Taiwan actually belongs to them. Do we really want to live in a world where every semiconductor that is used, assuming we continue to have access to them in the United States, is Chinese? I don't know that that's a great idea. It doesn't feel like a good idea. So, yeah, I would absolutely, hopefully, see that we do onshore some of this. Let's see if we got another question here. I think we did. This one's for you because I think you own it. Any comments on Qualcomm? Long 148, May 16 calls as it tops estimates. EPS of 285, revenues of 10.8 billion versus 282 expected in 10.6. I don't know if I mentioned this on the previous live stream, but I did mention it on one of them, that actually the earnings this quarter have not been bad. For the S&P, I think we have both sales and earnings beats on average. So your thoughts on Qualcomm? Because I know this is actually a name you own, I think.
Yeah. Well, it's actually interesting because the third quarter earnings estimates are above what the street expected, 270 a share versus 264. The stock is trading lower, though, actually. The stock, just looking over here at my screens, is about $8 lower. So down a little bit on this news. Haven't really been able to dig as closely yet through all of it on what's bringing the stock lower, because it actually looked like earnings were pretty good.
It looks like their revenue forecast is a little bit soft versus the estimate. So it's still, so they're guiding to third quarter revenues of 9.9 to 10.7 billion, which essentially surrounds the 10.3 billion estimate.
Right.
I mean, that's 400. The estimate is 400 million above the low end of guidance and is 400 million below the high end. So that seems like so it's a beat on revs, a beat on EPS, and in line on the forecast. That's how I would look at it. They're saying it's a soft forecast, or I'm seeing that reported, but that doesn't seem to be entirely true. And by the way, just speaking to earnings in general, so we have about half of the S&P reporting so far. 48% of those that have reported, so it's 270, a little bit more than half, 279 companies have reported in the S&P so far. 48.4% of those actually had a positive revenue surprise, and 21.5% of them were in line with revenue estimates. So that essentially tells us that about 70% either were meet or beat on the revenue line. On the earnings side, out of that same 279 companies, almost 76% actually had an earnings surprise, and another 4%, give or take, were in line, and only 20% reported earnings misses, of which Starbucks is one. So that means 80% meet or beat, most of them beating on the earnings side. So, but, let's also be reasonable. This is a look back. Companies are reporting a couple weeks after the end of the quarter, so.
Well, I think one thing that's kind of interesting, I'm just looking over here on some of the reporting of it. So it looks like Qualcomm still has a little over 40% of its sales in China. So I think maybe there's some concern that this sort of tariff war will play out and negatively impact their sales in that country. We did see a pretty dramatic dip in terms of percentage of sales in 2019 when the Trump administration first tried starting to do some tariffs on China.
Good point. Good point.
That percentage of sales actually then regrew to actually almost 60% under the Biden administration back in China. So we've now seen the sales dip back down to those 2019 levels, and maybe people are a little concerned that might affect future earnings lower, but you would think the company's guidance would start to factor that in and give you a decent estimate on that. So I'm surprised the stock's getting hit as hard, and you would have thought, yeah, there's maybe already some worry and discount in the value of the stock that this might play, but maybe this is starting to be a real concern for them.
Well, let's think about it this way. I don't know, how much did it fall in 2019?
So it went down to 2019 percentage sales in China were 47.8%. And now we're looking at 2024 sales of 45.8%. Percentage of
So
sales slowly declined, even a little bit lower than 2019. But again, like I said, it was up over 60% pretty consistently from 2020 to 2023.
I mean, if you go back a couple of years to when the company was doing about 30, had run rate revenues of about 36 billion bucks, and it was probably turning about $7.50 a share of adjusted EPS on that number. That's still less 20 times, and that is that would be a pretty big discount to actually what the street still is maintaining. Yeah, I mean that's a 40% discount to adjusted EPS estimates for full year 2026. So if you were buying a business and I told you you're going to own that business at 20 times next year's earnings, and that next year earnings estimate, by the way, I'm handicapping what the street's expectations are for it by 40%. That doesn't seem that terrible. I don't know that it should get totally beaten up on this. We'll have to dig into these numbers a little bit more, and we certainly will. So I realize it is now 5 p.m. Eastern time, and I know that you have some coaching responsibilities to get to. So I thank you very much for joining us today. I may stick around. I'm going to just take a quick peek at these other questions, but if you would like to make a quick jump and rejoin us next week, I look forward to that. Equity Armor Investment CIO, Brian Stutland, everybody. Brian, thank you so much for joining us. I'll let you go, and I'll just stick around and answer a few more questions for people if they have any.
All right, Mike.
It was good to see you. Thanks for joining.
We'll see you guys next week. Thanks, Mike.
All right, cheers. Okay, so just moving on here. So PC was asking, when do you get rid of your hedges? I tend to adjust them if I still think we're in a period of risk. So actually here we have, all right, so Michael Anthony, I'm going to guess, because I know you're a regular watcher. I thank you very much for that. And I've seen you have some comments, and you have a question here, or maybe it's a comment on Pfizer. Given that you bring up Pfizer pretty often, I'm wondering, and maybe you don't have to share it if you don't want to, but I'm curious whether you have what we call a concentrated equity position. This is not an uncommon situation, by the way. And we'll talk about Pfizer in just a moment. But, I deal all the time with people who, they work at a company for a very long time, and they accumulate stock as a part of their employment. So that's a part of their compensation, so they tend to accumulate the stock. My ex-brother-in-law is a lifer at Microsoft, so he gets paid in Microsoft. There's a lot of people here who have made considerable sums in NVIDIA. So I'm curious, Michael Anthony, whether that is your circumstance. Have you been, because it sounds like you bring up Pfizer a lot, so it seems to be the stock that you look at almost more than any other. I'm just curious whether this is your circumstance. So let's just take a quick peek at Pfizer and what is going on there. Pfizer, not a holding of mine. You brought this up before, and I think I had pointed out that it was trading at a pretty low valuation to street estimates. So we have kind of a look at the stock's performance here. Why don't we just, before we get to the fundamentals, we'll just take a look at what the technicals have to say. So I'm just going to bring up a whole series of different technical studies, the best performing ones, and you can see, despite the stock's weakness, and it did okay today, but despite the stock's weakness, it's still a mixed bag. We have the two best performing technical indicators, so the parabolic and the stochastics, both would be long the stock here. Those, as technical indicators, have also done pretty well over the trailing 12 months. So remember that the basis for the estimates that are used in the backtesting and optimization application, if I'm going back 1 year, it assumes a $100 million investment. So when you look at this over here where my cursor is, if you can make that out, which you might not be able to, so let me blow that up again, if that works. So over here, this number that I'm pointing to with my little cursor finger there, 18.72 million. So the parabolic, you can just, because we know this is just 1 year and we know that it uses $100 million as a basis, then you can see that the total return for this strategy would be just shy of 19%, which actually probably outperforms the market over the same period. And you can see where it would be a buyer and a seller. And you can see that where this one got long was probably not far off where you started bringing the stock up. So cover and go long on the short side, that took place on April 16th. and the stock was round about, yeah, it looks like it was about 20, just shy of $22 a share. So yeah, not bad. Little 10% pop that you get there. So let's just take a quick peek at the earnings. So we got a earnings surprise on an adjusted basis. The street was looking for about 66 cents a share adjusted. That's an average of, sort of the consensus estimate. Company reported 76 cents a share. So we got a nice 38% beat. That may actually, probably it is, I'm sure, going to account for the fact that it outperformed, didn't it? So this is not a super high beta name. We're up 2.6% today. I'm not sure that the, S&P 70 basis points, that's a good comp. Maybe we'll take a look at healthcare generally. Yeah, I mean, the numbers were good. I have not had an opportunity to read through everything that they had to say. So I will try to do that. So it looks like if we can see here. So we did discuss this on a prior show, which was that their obesity drug, they basically had to suspend on that. And that kind of is, that's the biggest market for these companies. Pardon the pun. One I could probably take advantage of, although I'm not going on any of these drugs. I always feel like the bad news comes out much later. And I think I'm more inclined to have more of a wait and see. It doesn't seem like there's been in my life an opportunity. Yeah, no pun intended with the wait. I don't, we'll wait and see. I have yet to see a circumstance where there really is a magic pill. And it really works out that way. So my 2 cents, I know people who are on these things. I know that people who have had tremendous success with them. I believe that, my former colleague from Options Action, Dan Nathan, I think he has been public about the fact that he's done it. He looks great, by the way. I haven't seen him in person within the last several months because I haven't been on the East Coast, but the last time I did see him, he was a changed man, and he has talked about it quite publicly that it's been very positive for him. But he also mentioned that there were some things he had to do. My point in all of this is that if you're going to really turn this story around, though, and that's the truth for any pharmaceutical company, you got to get that pipeline. You got to be in the right spot. Pfizer has really struggled with this over the years. But like I say, to me, the stock still looks quite cheap. There's a lot of bad news priced into it. All of the juice that was in this thing as a result of the vaccine has since been erased. And so consequently, you don't really have to contemplate that that's no longer going to be factored into the long-term fundamental story for this business. So, yeah, I mean, I think that's a decent story, as I said before, just on strict valuation. As you point out, decent dividend, 43 cents a share. So that's a chunky dividend, and that's something else to contemplate, right? So one of the reasons that people buy into companies like this is for the income, because there aren't that many places that you can get it. I'm kind of surprised on the dividend front, though, because usually when you see dividend yields as high as Pfizer's is, and theirs right now is whatever, we'll call it 7% to keep the math easy, you don't typically see dividend yields that exceed the risk-free rate for any prolonged sense of time. What that usually tells us is that the market is discounting the sustainability of that. But look, if they're going to do something like that, then presumably they think that the dividend is well covered. We're looking at full year estimated free cash flow of $16.5 billion, $16.3 billion for next year. So it would appear that the dividend maintains, is well covered. What I mean by that is that For those of you who have been watching or paying attention to Carl Icahn, there are businesses where the people who manage those businesses for reasons of their own, maintain very, very high dividends. Sometimes they do that by taking on additional debt. Sometimes they do it through things like asset sales, which means that effectively what's going on is you're selling off a little bit of the farm each time. So it's not a real dividend in that sense. But that doesn't appear to be the case here. So a great growth story. I'm not going to say that, but is it still reasonably valued at single-digit multiple? Good free cash flow on a handsome dividend yield. I think it's probably like I said before. I think it's still okay here. Okay, so with that, and now with Brian's departure, we have chewed up the better part of an hour. I thank all of you for tuning in and watching, like, notification bell, subscribe, all that good stuff. Hopefully we will be joined here on Friday at 2 p.m. Eastern Time by my good friend and colleague and co-author of The Options Edge, Professor Mark Guthner of Rutgers. And I hope you guys all tune in for that. We'll see you here. Thanks for watching.